John Petrides, thanks for coming back on Wall Street Unplugged.
Thanks, Frank. It's great to finally see you after 4 or 5 years of always doing phone calls. The only time I'm able to see you is on social media or on the website or the app. So
I know.
it's good
Well,
to finally see you.
I get to see your picture a lot because you're on CNBC. I love
Oh
watching
yeah.
your commentary and stuff. And I want to start off there, John, because the picks that, and I always admire this because for me, this is about our investors, and I know you care about that too. Just
Of course.
everyone cares about their clients, but the mom and pop investors out there, and I take pride in getting the right people on here and make sure that their picks are good and putting the right people in front of them for those picks. And your picks have been very outstanding. There was
Right.
Wasco was one of them. WSO up over 50%. You recommended that in late 2019, so that's even after coronavirus and everything. We had IPG, and I remember you picking that stock. And you talking about it, and you saying, "Yeah, I know this sounds crazy." And right when people are kind of like, "Yeah," it usually means that you're going to be right than wrong. I think
Right.
most of the time. So I just want to thank you for those picks, and I know you always do. You're going to give us some picks later on, but
Yeah.
I
Well, the
guess
pressure's on now, Frank. It's like I got tough comps I got to follow now.
listen, you deserve the credit. You deserve the shout out,
Thanks,
and I
man. I
really
appreciate
appreciate it.
that.
I know my listeners appreciate it, so I definitely want to mention up front. Now, let's talk about the markets in general, right? It's pretty crazy. COVID risks still around. You're looking at a market where Main Street is obviously not doing that well, but Wall Street's doing very, very well. Most of that's due to a lot of policies. How are you playing this market? Not from we'll get to the mom and pop investor part because I know a lot of them are struggling, but just you're a person that has to give investment advice. What are you telling them now where the market's just hit an all-time high, which seems crazy given all these risks? Do you see it really risky heading into election season? Do you think that you are finding ideas, or is maybe you taking profits on some of those winners?
Yeah, I really feel that we are at crossroads. Over time, when I've been a guest on your show, 15, 16, I said, stocks look really interesting here. And then 17, 18, 19, I said, with interest rates backed up, definitely a more balanced portfolio looks attractive, is how you should, the stocks have run, but bonds have sold off. So a balanced portfolio definitely seems the most appropriate. Today, I really feel we're at crossroads. On so many levels, politically, economically, the markets, socially. We're at a really interesting time because what happened when we had the sell off in March, right? So COVID hits, we have the sell off. And what needed to be done, and it's been doing, is build a bridge for you and I and for all of us, for the economy, until a vaccine was approved and distributed to the masses. The Fed has laid the first foundation of the bridge by basically printing money and buying anything not nailed to the ground. Of course, I'm exaggerating a bit, but the Fed is out there making sure the wheels are greased in the economy. Okay, and they've achieved that part. Then the government has come through with the CARES Act and wrote a huge check to put money in everybody's pocket to help soften the blow because everyone's cash flow basically got sucked dry because the amount of people that got laid off, the country was shut down, businesses shut down. So those two pillars are done. What we're waiting for right now is the second round of stimulus. And clearly, to me, it does feel like politics is in play. Those that have an axe to grind with the president have the ability to drag their feet. On the other hand, it goes back and forth. So you have issues there, but we still need to get to where the vaccine is approved and distributed. So and what I've seen or what I've heard, at least from the CDC and from pharma companies, it looks like that should hopefully be the second to third quarter of 2021, right? Is when we at least get it out to the first responders or wherever the pecking order is. And Frank, at the end of the day, all that does is hopefully make the entire country feel comfortable spending money again, feel comfortable, being in a social gathering. I'm in the Northeast, I'm in New Jersey, you're in Florida. Different pockets of the country are responding to this differently and are feeling different. And it's not that one is right or wrong. It just is what it is. And the problem is we have to get the whole country on one page. So I really feel like we're at crossroads right now. But the longer that it takes for the economy to get back on track, the longer it takes for the more prone the market is to sell off.
And let's talk about that because if the market stays off track, I mean, the elephant in the room is the Fed, right? I mean, they're going to come out Jackson Hole. They're going to say they're going to, they're preparing everybody about inflation, right? Well, forget about 2% target. And this is a
Yeah.
lot different, guys. I know you know this too as well, John, where in TARP, it was $470 billion. But that
Right.
was in excess reserves given it to the bank where they could control it. This is 7 trillion so far that
Yep.
has been directly injected to people's pockets through, advanced unemployment benefits, tax checks. You're seeing PPM loans everywhere. So this is going to spur inflation. To me, this talk tomorrow is going to be more like just in case if it happens, let's mention it. This way, we always
Yep.
like to get ahead of things, which we're going to see inflation. But even if the economy doesn't come back on that time schedule, which I think is a great time schedule, by the way, because there's a lot of people working on vaccines. I think that's going to provide confidence in the market for people to spend more.
Mhm.
But with the Fed there, right? I mean, it seems like they're just going to continue to spend. Does that give you the green light to keep,
Well,
putting
that to me is the number one issue why the stock market is above all-time highs right now, is because the Fed prevented, a Lehman Brothers like situation by printing all of this money. That really is. And then of course we could talk about the concentration in tech and the FANG stocks, which we've all spoken about ad nauseum, and we know this is a 5-horse race driving the S&P 500. And as your listeners know, the S&P 500 is a market cap weighted index, meaning the larger you are, your size of your company, the more weight you are. But if you look on the average stock, right, so an equally weighted index, the average stock is negative for the year, low single digits, but it is negative for the year. So, and I think that's more important rather than focusing on the S&P 500, which is dominated by one sector. But clearly the Fed here, by printing so much money, has forced all of us to take on more risk. I mean, in fact, look at the bond market. And in fact, I think long dated bonds are a bubble, and it could be in a bubble. And what could be perceived as the safest part of a portfolio may actually be the one that's at the most risk. When you have the 30-year U.S. Treasury with below a 3% yield, the 10-year U.S. Treasury at a 0.6% yield, 0.6% you're earning for the next 10 years on bonds. You can't find yield anywhere. Investors, those yields have come down so much because the Fed is printing so much money. So it forces investors to say, well, I can't find any yield in the bond market. I'm getting nothing for my cash. Where do I go? You go into stocks. And I think part of the reason of why the big cap tech stocks have rallied so much is because they're sitting on so much cash on their balance sheet. You don't have to worry about Apple's liquidity or Google's liquidity or Microsoft's liquidity. You don't have to worry about if they're going to be able to pay out their dividend or reinvest in their business because they're sitting on hundreds of billions of dollars of cash. That is becoming, in my opinion, a bond substitute. Why not own an Apple stock where you're getting, whatever, north of 1% yield with a company has a balance sheet with $200 billion in cash, so what the Fed is trying to do is force us out the risk curve to spend money and invest to get the economy inflated again.
And I know that because when we send notes and I always get little topics that we want to mention and everything, and we're pretty much, we do this all the time, so we can just freestyle. So it's just like little bullets. But you talked about the part with income, because even when you have the Microsofts and Apple, I think people lose sight of that, where yes, you're buying a growth company that has amazing balance sheets, but they can handle liquidity of the bond market, where these are, man, I never thought I'd say $1 trillion, $2 trillion companies, right?
Unbelievable.
Which is unbelievable. But it also, doesn't it bring into play, like, say some of the stocks that have underperformed on the dividend side, like the Cisco's that report a bad number, Intel report a bad number. These are companies that have, 2.5%, 3% yields. I don't know where they're going to be next year. They could be down. But if I had to place a bet, I'd be pretty sure in 5 years from now that they're going to be higher than where they're trading right now. And you can earn that 3% rate, which is, again, like you said, 0.6 or almost a 0.7 here in a 10-year. They seem like really, even the ones that aren't performing well, that actually had bad quarters and have a little bit of problems, it seems like if you're really looking to park money, these are pretty good places if you're looking at a 3 to 5 year outlook, right?
Yes. So the problem, the pros and cons of low interest rates and what the Fed is doing by printing so much money. So if you're a borrower, this is heaven, right? This is a great time for you. Look, if you're buying a new house, you have the credit quality to take out a loan on a car, go for it, right? I mean, right now you're getting, such cheap rates on a 30-year mortgage and other terms of financing. Look what's happening on the corporate side. Johnson & Johnson took out a 40-year bond the other day at 2.45%. 40 years. Apple did a 30-year bond, 2.5%. Google, a 30-year bond at 2.5%. Amazon, a 30-year bond at 2.75%. That's free money. That gives them, if you thought they were big before, how much optionality does that give them? They're printing all this cash. Now they have extra firepower. They could buy back a ton of stock. They could pay out their dividend. They could do massive acquisitions. I mean, and it's not just, I'm focusing on Amazon, Apple, or Google, but there's Johnson and Johnson. I mean, all the way down into even the energy market companies, big cap energy companies are having the credit markets opened up to them. So for the borrower, this is, manna from heaven. If you're the saver, it's the worst environment, and I'm of the belief that COVID will not go away, but we'll have a vaccine. I don't think this is the bubonic plague that wipes out half of humanity. I don't think this is Ebola. I do think that we will be able to contain it to some degree in the future. But the fact of the matter is, more and more people, the world population is growing. More and more people are aging. They're living longer, and others are retiring earlier. So I bring that into the equation because if you're now a saver, you no longer have income coming into your portfolio. You have to live off the cash flow of your investments. The idea of the pension system, Frank, that our parents and maybe grandparents had, that's gone, right? Pensions are gone. No, unless you're a teacher or a cop or a first responder or something, you don't have access to a pension by and large, right? So you're relying on the money you've saved in your 401k, your 403b, or whatever retirement plan that you have, right? So when you retire, you have that nest egg that you now have to live off the cash flow of your portfolio. But as the baby boomers continue to retire, what are they living off of? So in theory, your retirement, you should have more of your portfolio in bonds in theory and less in stocks because you're now moving to the distribution phase rather than the accumulation phase of your income. But you can't do that now because you can't earn anything on your bonds. If you have all of your retirement in a bond portfolio, you're going to eat through the principal because you're just going to live off it. So you're forced out of the risk curve. So that's the problem with what the Fed is doing. So you have to go out and find equities that have dividends. Now, here's the interesting thing. When we talk ad nauseum, Frank, about growth outperforming value, right? Everyone knows that story. The last decade, growth, think tech, healthcare, biotech, has crushed value. Think utilities, financials, energy. It's been the widest gap in a generation of one style versus the other. But there are other factors of investing. It's not just growth versus value. There's dividend as a factor of investing. There's momentum as a factor of investing. Companies that take leverage, that pay down debt is another factor. Share buybacks are a factor, right? These are all different types of styles that investors invest in. The worst performing factor this year is value. The second worst performing is dividends. The third worst performing factor is companies that buy back stock. And the fourth worst performing factor is companies that have leverage on their balance sheet. So if you are using if you're using cash in any way, you're being penalized. On the other hand, what's working, it's all momentum, really. Momentum, beta if you have volatility, and growth. Those are the three factors that are working, which to me doesn't make much sense because in an environment where interest rates are low and they're going to be lower for longer, where are people getting income from? So I don't foresee that dividend factor being the worst performing factor 12 months from now. I would have figured at some point cooler heads prevail and people rush into or start moving into dividend paying stocks because they can't get income anywhere else.
So you're telling me that you're not going to explain how Tesla is at 2,000 based on fundamentals? Is that what you're saying?
No,
that's what I did.
Unbelievable, man. Unbelievable.
Okay, so now it's time to have fun. And excuse me when I use this word because, the election, right? And we're talking about dividend paying stocks, talking about rates, we're talking about, inflation and things like that, which are long-term trends, short to long-term trends. But we do have an election coming up, and I'm going to use this word because I don't think I can describe it better. Where it's kind of like a shit show. You have to hate one side. Has to hate it's black and white. It's no compromise. It's no nothing. I mean, you can see that from the conventions. It's pretty crazy. However, I try to say, you want to put politics. When it comes to investing, you have to separate. You got to separate your emotions because depending on who wins, it's going to have serious implications for your portfolio. I mean, even something like, let's just take energy, where alternative energy, Biden wins. I would think that's going to do very well. Fracking, probably not well. So it is going to matter. Are you structuring your portfolio in a way where you have a game, plan A, plan B type thing? Or is it, hey, you know what? We're just looking at the markets long term. And if you look at the S&P 500, it's the greatest secular chart in the world from the 50s.
Right.
We've had how many presidential, elections, but how are you playing this where, obviously I think it's a pretty big deal from a trading perspective, but maybe from a long-term perspective?
So when we manage for clients' portfolios, we're not thinking about who's in the White House for how we're going to position. We're positioning their portfolios for their long-term objectives. So and we diversify accordingly based on their time horizon, risk tolerance, income needs, all of that stuff. And so yes, the outcome of the president of the election could or may or may not produce increased volatility. There are certain plays that we had already had in the portfolio or have in the portfolio currently that will benefit, i.e., as you mentioned, a Biden election, alternative energy, that sort of thing. But we also have some, energy and financials in the portfolio that, if Trump gets reelected, that those should do well in. So, what I learned in October and November of 2016 is I remember talking to a lot of clients that were very, very nervous that Trump got elected. This guy, he's unproven. He says things, he's going to build a wall and I can't, if Trump gets elected, I want to go to 30% cash. Those are the questions, those are the phone calls that I was dealing with.
And we were able to sentiment back then, right? I mean, everybody, I thought like gold would take off. I mean, gold turned out to be terrible.
It did. No, it did. It did. Frank, it did. But for about 5 hours, gold and treasuries, I remember being up that night, gold and treasuries were rallying up until about 3 a.m. on the day after the election. And then basically the light bulb went on and we're like, a Trump policy of, lowering corporate tax rates is good for corporate America, which is good for the stock market. And you had a 12-month rally in stocks of, 30 something percent, right? The market took off. So my point is, trying to predict the market reaction to an election is really hard, is really hard. And understand that, 4 years after someone is elected, they may not be in office. To me, this is more of a pivot of not necessarily the presidency from a market reaction. To me, I'm not focused necessarily on the presidency. I'm focusing more on the Senate. Because if it's a Democratic sweep, in my opinion, the market will not react positively because then corporate taxes are probably going up. The Biden's talked about, I've heard elimination of the step up in cost basis if you have a stock in a taxable account that you're inheriting. I've heard things like increases to taxes on dividends. So, and by the way, this isn't just, I'm not making a political statement. I'm giving you and the audience my thought on how I think the market will react. Markets rarely do well when one party dominates. It does well when there's a check and balance, where the legislature is split. So, it rarely goes in one direction. So for me, from a market standpoint, I think the market would react the best to a Biden presidency, a Republican Senate, and then the House is going to stay the way it is. And the reason why I say that is I think the market would interpret a Biden presidency socially to probably have less social unrest relative to what we're seeing now. I'm as a total judgment call. I have no idea. The best situation from a market standpoint, I think, is probably going to be a Trump presidency, Republican Senate, Democratic Congress is probably the best, how the market would react the best. But I do think the market would go up under a Biden, Republican, Democrat sort of scenario. That's just sort of how I'm seeing the election results on August 20th, the end of August.
I think it's funny how we're always politically correct with these things, right?
Yeah, I know. It's contentious.
Yeah.
We're in a contentious environment. And again, from my standpoint, when I'm managing our clients' money, the last thing I could do is overlay my emotions to their portfolio and or my political thought. If my political opinion is personal to me and my family, it should have zero bearing on how I manage money for clients. So that's why I have to distinguish the two. It's not because we live in a politically correct society. It's because I have to be as emotionally neutral as possible when managing clients' money.
Yeah, and don't worry, I'm going to give you email address for anyone who wants to.
Yeah.
So, all right, let's get to the fun part here because we really covered a lot of stuff, which is important, guys. Some people think the economy and they feel like it's boring. There's a lot going on right now. It's going to impact your portfolio. I love how we bring it all together to say, okay, we talked about dividends as well. You love offering some of your picks. That's what you do. You recommend stocks at Tocqueville and portfolio management. What are some of the ideas right now? I mean, is there anything that you like specifically?
Yeah, so like I said, I'm playing on that theme, two themes. One is that we're at crossroads, and meaning that the bull and bear case right now can be argued convincingly, in my opinion, with a high degree of probability. And that's sort of the tricky part right now of where we are, and the idea of income, that I think people will need income. It reminds me, the stock market kind of reminds me of, the REM song, "It's the End of the World as We Know It and I Feel Fine." Like, you look around you, and the economy is in really, your people are struggling. You have all this, everything else going on, but yet the market's at new highs. It's kind of strange. So, two plays again on the income. One is, I know, Frank, that I don't think I've ever pitched an ETF on your show before, but we own in our enhanced income strategy. I own it personally. I like SHYG. So it's Sam, Harry, Yellow, George. It's the iShares short duration high yield ETF. Right now, you're getting about a 5.3% dividend yield. The expense ratio is 0.3, so it's 0.3%. And so what I like about this is the Fed is printing a ton of money. I do think inflation will be an issue at some point in time. I think long dated bonds have rallied unbelievably because people are stretching for a yield. So the longer the maturity right now, to me, is the biggest risk because it's not factoring any sort of inflation. So this ETF only owns bonds that mature less than 5 years. So it's very short, right? So the question is, where do you think bonds will be? Where do you think interest rates will be over the next 5 years, right? Going higher, but if your bond matures within 5 years, you have less downside risk, and you're getting a 5.3% dividend yield on the portfolio. So you get your income play, and you're lessening your risk. So and you own a basket of bonds, so you don't have to worry that as much. You get a basket of high yield bonds. You don't have to worry that much on the credit side if the bond was going to default, because you're diversified amongst the basket of bonds. So I normally don't pitch bonds within your client's portfolio for your investors, but here's a way, if you're looking for some yield, if you're looking for something non-stock, it's ETF, it's fairly low cost, it's liquid. That's a good play, in my opinion.
I like this too, because you see me where now that we do video, people can see.
Yeah.
I'm always doing this when you're talking and different things. I'm looking up something, but I love looking at the 5-year chart where it's kind of like going back 2015. It's been steady, right, offering a nice yield, and then it fell from 46 to 30, whatever, 38, which is a big move for something like this in March, and now it's slowly making its way back up. But if you can see the economy getting better, that's what you want. I think that's what everybody wants, right? Not the dividend, but they wish they didn't have to buy a stock to get the yield. You're getting something like this that's kind of steady. That's not going to be, you wake up and it's down 15%, then it's up 20%.
And you have the Fed in your corner, right?
Yes.
The Fed, if we have a step backward where the Fed's just going to continue to go out there and buy more assets, So, it is a moral hazard. You don't want to buy something, but, the Fed is got your back. And if things deteriorate further, where the Fed, who's right now buying investment grade bonds through its balance sheet and treasuries and agency mortgage-backed securities, they can go down the ring and buy high yield bonds. So you have protection here, in my opinion, from the Fed. All right. Yeah.
And what about any other ideas?
Yeah. So from the stock side, again, I maybe boot off the stage from your investors because there's nothing sexy about the next name, but Coca-Cola. We added Coke to our enhanced income strategy. Again, do I think volatility is going to pick up in the market over the next 2 months, 3 months? Probably, because of the election. So in the short term, do I think Coca-Cola will weather a volatile market relative to other stocks? Yes. Coke is still 20% off of its off its recent high, so it has not recovered like the stock market has. You're getting a 3.4% dividend yield. The consumer staples sector has been on fire. Why? Because our entire wallet share over the 6 months has basically been geared toward the supermarket. We're not going out to restaurants. We're going to the store and we're buying everything at the supermarket. And all those packaged good companies, think of General Mills and Kellogg's and all those guys, they don't have to offer any coupons. They're pricing their cereals at full price. So, and those stocks are trading at very high multiples. So here's a consumer staples company in Coke, that's off its highs. You're getting a 3.4% dividend. They grow the dividend every year from an income play. It's historically less volatile than the overall market. And there are a couple other plays as well. Over the last couple of weeks, you've seen a weakening in the US dollar by and large, the last 2 months. The dollar has been very, very strong relative to other currencies around the world for the last 3 years. And market strategists have been waiting for that to come down, to come to parity. Why is the dollar so strong? And it really is a bit of a conundrum when we have $25 trillion in debt on the balance sheet of the US and our economy is sucking wind and we're still dealing with COVID, where other countries are starting to rebound faster than we are, and they don't have the debt that we do on our balance sheet. So if the dollar does weaken under that scenario, and by the way, the Fed is printing so much money, why should a dollar be trading at such a premium to other currencies? So if the dollar does weaken, Coke gets 60 to 70% of its sales outside of the US. So they will benefit actually from a weaker dollar. And then the final play here is there's actually a growth story with Coke. They have a new CEO. The former CEO, Kent, spent most of his time working on supply chain efficiencies within Coke in of itself to make it as lean as possible. New CEO comes in. He's inherited that lean supply chain, and now he's overlaying different types of beverage channels for Coke to get into. Coke is going to be distributing coffee. They're getting big into energy drinks. They're coming out with their own. They've come out with their own hard seltzer in the market because they realize, hey, we have this great bus. Let's start putting other passengers on it outside of syrupy soda drinks. And they're putting different forms of beverages inside, which I think is going to lead to a whole new growth trajectory for Coke. So there's a long, and they are making their effort. Coke is not an ESG company. Plastic bottles are not good for the environment. The company's well aware of this. So they're trying to really work on and harness that, where they'll be reducing plastic bottles, or at least be a net plastic bottle neutral company by 2030, which over time, maybe you get a catalyst from the ESG investors. So you have a lower vol play. You have a dividend of 3.4%, which is significantly higher on a high quality A plus rated company balance sheet. And then you have this sort of longer term growth play where they're moving into other forms of beverages to distribute. So again, it's not overly sexy, but it does the trick, I think, in this environment.
Yeah, I love the pick here because a year from now we revisit this. I think you're going to be very, very right on this. But it's funny how just even now how we're programmed, right? You see the Nikolas, you see the Teslas, you see these crazy stocks, the Microsofts. It seems like it's easy to make a killing in some of these cult stocks that keep going higher and higher. So people dismiss Coca-Cola. And I just want to remind everybody too, because I did the same thing when I started looking at cloud computing for my newsletter. And it's a large cap, mid cap newsletter. And I went through every single cloud company, and there was nothing to compare to. I mean, Amazon just blew it out of the water, right? You can say Microsoft did well, and I missed Microsoft a little bit, but we wound up recommending Amazon at 900. And so, and it went up tremendously. And I did the same thing, the same pitch. I was like, guys, I know you're not paying me. You can find this on your own, but this is going through the research. And like you just explained, looking through this is a good investment. And I hope people listen because the dividend makes sense. I think you have very low risk here. Economies are opening up, restaurants are opening up, not just the Chipotle's and the Domino's that are doing good, but you're seeing more of that, at least where I am in Florida. All the COVID stats are getting better. Not great, but better, which means, you're going to see more things open up as time goes by. And I just think, it's a good play, and hopefully people listen, because when the best play is something like Coca-Cola and you really like it, sometimes, I can see people just, Coca-Cola, but it makes a lot of sense here. It really does.
And I own it personally. We own it in our enhanced income strategy. So, this is something where I think right now it just checks a lot of boxes. And I was surprised when I came across the name, but as I was looking through my screens and what works for what we're looking for, that Coke was still 20% off. I mean, this is underperforming the consumer staples sector, which has rallied strongly. So, if you're looking for value within that portion of the portfolio, that sector, consumer staples, where, you're trying to find a good name, again, I think Coke fits that box.
Two other things here, and I'll let you go. The first is, if someone wants to learn more about you, could they do that? Because I know they like watching on CNBC, but maybe they want direct contact with your company. So
appreciate that. So so go to where I'm at, Tocqueville Asset Management, Tocqueville.com. You find all of our good stuff. We have a very deep team. 9 or 10 analysts. We have 13 or 14 portfolio managers. Managing various strategies. We have a mutual fund strategy and then private wealth. I'm going to be posting a commentary in about a week or two. It's free. We basically did a case study, Frank, on J.C. Penney. So J.C. Penney went bankrupt, but J.C. Penney in 1997 issued a 100-year bond. 100 years, right? So the idea, so the idea behind the commentary is, things change. At the time in 1997, that may be a joke. Half of your listeners probably never even went into a J.C. Penney. But in 97, Amazon just went public. China wasn't even part of the World Trade Organization. The Fed funds rate was 5.25%. Okay. So just put things, Apple was on the verge of bankruptcy, and it got bailed out by Microsoft and Bill Gates. So my point is, nothing lasts forever. So for someone to issue a 100-year bond back in 1997, people say, yeah, I'll take a 100-year bond for 7.5% yield, coupon on JCPenney. What's wrong with JCPenney? It's a blue chip retailer. Nothing can happen to it. 25 years into the 100 years, the company's bankrupt. What if Apple issued a 100-year bond, right? The line would be about the block right now for people to get it. But that means you could forecast what's going to happen 100 years from now. My point is, nothing lasts forever. So you have to be very careful. Anyway, that's the point of the commentary. So check it out. Tocqueville.com. In about a week or two or so, that commentary will be up there.
All right. Now, the most important thing here, much more important than anything we talked about, you and your son, I believe that you won fantasy football last year because you let me know about 80 times, which is, I would have let you know 80 times if I would have won, but I didn't.
We are the reigning champs.
But fantasy football, are you into it this year? Well, I'm having my first draft on Thursday. Really hard because players are opting out and electing to sit out. But at least we're having fun. We're going to be hanging out a little bit, friends, and just doing something other than talking about COVID and staying in your home. I'm looking forward to.
I just started looking at research and podcasts. To be honest with you, I have been a little disengaged. Part of it is because I don't know who's going to be healthy, come draft time. Who gets, so that throws everything off. But starting to look at everything, what I find interesting this year more so than others, there's so much parity at every position. Like wide receiver is super deep. Running backs are deeper than normal. You want your first guys up front, but even down the road, you can find quarterbacks are crazy deep. The only position that really isn't deep is tight end. You have Kelsey, and that's kind of it.
Yeah, you have like 2 or 3 of them, right? So, it's just, I hear you. Tight end is tough. You want to get one a little bit early. So, but other than that, I'm looking at it too. And I know we have a lot of fantasy football fans out there, but it's just nice to get away from everything. And I'm looking forward to that. And I haven't even really been studying that much either. So, other than the first 2 rounds, but, good luck this year, fantasy. Thanks you so much for coming on. And, always great. Always pleasure. And
congratulations on the success, Frank. You're everywhere. Your format continues to evolve. The video streams and your stuff on social media is really coming across sharp, and I know I get a ton of value out of it. So
I appreciate that. I really do. Thank you so much for that. Yeah. So all right, listen, definitely join us again soon. I'll call you soon. I'm going to talk to you in between, and again, good luck with fantasy football, buddy.
Thanks, sir. See ya.